Welcome to Trading Analysis. This is lesson 4 of module 2 in our Price Action Foundations course. In the previous lesson, we learned how swing highs and swing lows form the foundation of market structure. Now we're going to look at one of the most popular concepts in technical analysis: support and resistance. But we're also going to fix one of the biggest mistakes traders make when drawing them. Because here's the truth: support and resistance are not lines, they're zones. And that small difference can completely change the way you read the market. The one pixel problem. Let me ask you something. Have you ever drawn a support line? Price comes down, touches it, breaks through by 2 or 3 pips, stops you out, and then immediately reverses exactly where you thought it would? Of course it has. We've all been there. You stare at the screen thinking, seriously? 2 more pips? Meanwhile, the market is just sitting there saying, I never promised to stop on your 1 pixel line. The problem isn't always your analysis. Sometimes it's your drawing. The market doesn't see lines. Most beginners draw support and resistance like this. 1 perfect horizontal line. Nice, clean, precise. It feels satisfying. The only problem? The market isn't that precise. Think about it. Thousands of traders around the world are buying and selling at slightly different prices. Institutions aren't placing billions of dollars at one exact number. Orders are spread across an area, which means price usually reacts inside a zone, not at a single line. That's why professional traders think in areas, not pixels. What is a support or resistance zone? A support zone is simply an area where buyers have repeatedly stepped in before. A resistance zone is an area where sellers have repeatedly taken control. Notice I said area, not exact price. Price might react near the top of the zone, sometimes the middle, sometimes the bottom. The important part is that buyers or sellers consistently respond there. That gives the zone meaning. The more touches, the more important. Imagine you're walking through a park. You notice a small path through the grass. One person probably walked there. Now imagine that same path has been walked on hundreds of times. Eventually, it becomes obvious. The same thing happens on charts. The more times price respects an area, the more traders begin paying attention to it. That doesn't mean it will hold forever, but it does mean the area becomes more significant. 1 touch? Interesting. 2 or 3 clean reactions? Now you've got something worth watching. Role reversal, one of the coolest things in trading. Now here's where things get really interesting. Sometimes support breaks. What happens next? Many beginners think, well, support is gone. Not necessarily. Very often, old support becomes new resistance, and old resistance becomes new support. This is called role reversal. Think of it like a football match. One team loses possession. Now they're defending instead of attacking. The market behaves the same way. Areas where buyers were once in control can later become areas where sellers take over, and vice versa. Once you start noticing role reversals, you'll begin seeing the market very differently. The mistake most traders make. One of the biggest mistakes beginners make is drawing 20 support and resistance lines all over the chart. At that point, it's no longer technical analysis. It's modern art. Keep it simple. Focus on the most obvious zones, the ones price has respected multiple times. Remember, your chart should help you make decisions, not hide them. Key takeaway: if there's one thing I want you to remember from this lesson, it's this: support and resistance are areas, not exact prices. Think in zones, not lines. The market is built on buying and selling pressure, not mathematical precision. The sooner you stop expecting perfect reactions, the sooner your chart analysis becomes more realistic and ultimately more effective. Now that you understand where the market is likely to react, the next step is understanding how price actually moves between those areas. Because markets don't travel in one straight line, they move in powerful pushes, followed by pauses and pullbacks. In the next lesson, we'll explore anatomy of a move, impulse versus correction, and learn how professional traders distinguish between strong momentum moves and healthy pullbacks. I'll see you in the next lesson.
Goodbye.